A big tax bill is not a bad thing. Here's why you should celebrate it. Follow my video and I'll explain more. If you're new, my name's Michael from MDH Accountants. If you like our video, click subscribe. We give videos about business growth, tax tips and also business advice. If you're panicking about your tax bill and it feels large, you may be looking in the wrong direction. Let's fix that today. If you work with an accountant or a tax advisor and you've absolutely nailed everything that you possibly can do to minimize your tax to as low as possible, you should be celebrating, because ultimately that means you have made a massive amount of profit compared to the prior years, and that is only a good thing. Now, if you haven't had the opportunity to sit down and nail this area with an accountant or a tax advisor, here's our book. It's called 70 Plus Ways to Pay Less Tax. They're all good, they all work. See which ones are relevant for you and your business, and are you taking every opportunity to nail every one of those 70 ways to get it down to as legally possible? Because if you're not, download it today and start on it. This book is completely free of charge. A big tax bill means a lot of money. If you've absolutely nailed your cash flow and the profit is not sitting in other people's bank accounts like your customers, you are going to be sitting on a good pot of money. Make sure you celebrate that success, because that will give you additional chances to invest more in the business, invest more on your personal balance sheet, or take more income for you and your family so you can have an even greater lifestyle than you've got now. A shift in mindset. Understand how taxes are actually driven. Understand what the rates are, both for your company and also what that means for you personally, because once you get an understanding of it, you're gonna know how it's been driven. Now, some of the clients that we work with, when they're looking at investing more in their business, they will sometimes take the after-tax costs. So if they're looking to invest, say, 100 grand into equipment, they're going to know that they're going to get a 25% corporation tax deduction on that amount if their profits are over 200,000. So then they're going, oh, the real cost of that is then 75,000. Oh, that seems a bit more feasible, because future profits I could earn from that 75 could be 3, 4, 5, 10x, who knows? They're all relevant to every business. But when you start looking at things, it's then a lot different. A lot of growing businesses as well actually look to grow their business with debt. It gets you there a lot quicker as long as it's used wisely. So if you've got something that's say a 10% interest rate, just for a nice round figure, you will then know if you're getting 25% tax relief on that, that cost of capital after taxes then cost you 7.5%. So if you then look at the projects that are coming ahead, or if you're looking at the equipment that you can buy that can earn you more money, you're then saying, right, okay, well, 7.5% is my cost of capital. If I then use that capital on a project and earn 15%, I'm doubling my money using someone else's dosh. Now that can be nothing but a good thing as long as it's used wisely. So when you're looking at investing, which is cost within the business, use the after-tax costs. When you're looking at how much money you need to make, go backwards. And the way that you do that is you start off with what income do you need to earn via dividends. You then gross that back up for corporation tax. That's going to be somewhere between 19 and 25%. So you know that your profit before tax needs to be a minimum of this. If you're going to take all of it out, sometimes people will leave a certain chunk of money in the business. It can be 50, 100, 200,000. So they build up strength on their balance sheets. So you know that from a personal income point of view, you need to gross it up for corporation tax and also understand how your personal tax is driven well. You should be doing this every single year. We call it an upside down cash flow because it will help give you just massive clarity that, right, I need to earn this to then earn this personally. And then the personal tax that I need to pay on this is this, which means that I've got X amount per month to spend on my family and do all the things that I want to do, manage to support yourself and have fun too. So once you understand and now a lot of them areas, a lot of things become clearer and tax becomes less of an ache. The real problem, having a tax bill but no money. There could be some problems in relation to financial planning, but also other reasons why you'd be making a good profit but you're not having the cash to pay it is you've absolutely ripped all the money out of your business that's sitting in your director's loan account, so you've spent the tax money yourself. All of us as accountants have come across clients that have done that over the years, and I'm sure there'll be more in the future. Number two could be that money is not sitting in your bank account, it's sitting with your customers. So you may be seeing massive growth where the invoices are going out the door, but say that you had debtor days of 25 days, they may have gone to 50, then 25 extra days will not be sitting in your bank account, which may be the difference between you able to pay your tax on time or not, which is potentially going into a repayment plan or looking at some form of finance to then be able to settle that tax. Spending too much too fast. Now, it's really easy in business that you get a bit too excited. You go, yes, I'm going to spend on this because my turnover is going to be this, and it falls short. I've done that myself. Loads of other clients have done themselves where you've just got a bit too overexcited. Now, I'm not, at the end of the day, I'm not saying sit here and be a miser and count every penny and give your team a member a piece of coal at Christmas, but there needs to be a line. So you need to basically have a rough idea of how much tax that you should put away. So if you've got a quarterly call with your accountant, you can easily pull up your accounting system, have a look at your P&L, do a rough calculation, say, right, I'm either taxed at 19 or 25%. I need to make sure that this is put aside within the company. You can even do that as a little journal where you then have a bucket that's put aside where where you know that the tax bill is going to be this. And if you haven't got the money in cash, then you need to put it aside. Some clients that we have, really cautious, and I love this style, they put it in a separate savings account and then it's there for when the tax bill comes. There are no surprises. Not setting any money aside for taxes. So are you the type of business owner that currently looks at that bank statement and goes, that's nice. I can see the Maldives here. Oh, Mexico. Let's just do it. And then we'll worry about the consequences later. Again, come across many business owners that have done this where they've been really busy, they may be tired, and they'll just have a knee-jerk reaction, bang, whim, right, I'm going on this holiday then, I'll worry about the taxes later. Again, it will come back and haunt you. So you may need to work that bit harder when you come back to then accumulate that money back, but ultimately you will need to sell this. So make sure when you're running your business, you've got a bit of a plan, you've got a bit of an earmark of how much tax that you need to put away. The worst case scenario is even if you did your accounts really quickly after year end, say within 2 or 3 months, you'll still have 6 months to sort of prepare for it. You may have other issues with overdrawn directors' loan accounts, which is a completely different video in itself, but make sure that you're not just doing stuff on whims or looking at your bank statement and going, that looks tasty. So what to do next? Have a really good idea of your cash flow, have a really good idea of your profitability so you know your tax. Now, also bear in mind that sometimes tax rates gone up. So we've seen that taxes have gone from 19 to 25% for some of our customers. So that's like a 33% increase. So if they're paying 30 grand last year, it could be 40 this year. Now, if you haven't listened or you haven't had the opportunity to talk to an accountant, that can be a bit of a punch in the face. So make sure that you're aware of, yes, what your profit is, but also what the tax rate's too. Because I bet over the last 12 months and going forward, this is gonna catch a lot of people out. Hope this video's really helped. But if there's any questions that you got or stuff that's a bit of a grey area, I'll put my link below. Click the calendar link. This will allow you to book a meeting in my diary. I'll take on board any questions you've got. I'll get to know you and your business, and I promise there'll be no pushy sales pitch. But if you're that business owner that's ready for some growth, we've got our own business growth program. We talk about every single driver that drives profit that will help you scale and elevate your business. So one, you can take more money for yourself, or you can invest more into your personal balance sheet and you can invest more in your business. I'd love to see you on that course today. Click the link below and sign up.